All right, let's dive into a really interesting one today, ODP Corp. Now, this is a company that just told the world its sales dropped by 8%. You'd think the stock would get hammered, right? Well, it jumped nearly 10%. So what's going on here? That's the puzzle we're going to solve together.
I mean, just look at these numbers. On the one hand, revenue is down 8% compared to last year. That's a tough pill to swallow for any business. But on the other hand, the market's reaction was a massive 9.5% rally. This just doesn't add up on the surface. So why on earth would investors get so excited about declining sales? To figure this out, we've got to look past that big, scary headline number. We need to dig right into the details of their Q2 earnings report, because trust me, that's where the real story is hiding.
Okay, so here's where it gets interesting. Take a look at the revenue line, just under $1.6 billion. That was pretty much exactly what Wall Street was expecting. So, no big surprise there. But then you look at adjusted EPS, and that is a completely different story. That's where they hit it out of the park.
And we're not talking about a small beat here. ODP delivered adjusted earnings per share of 51 cents. The analysts, they were only expecting 36 cents. That's a 15-cent beat. That, right there, is the number that made everyone sit up and pay attention. It was all about the bottom line.
And that really is the answer to our puzzle. This whole thing became a story about profit, not revenue. Investors looked right past that sales decline because the company is showing some absolutely incredible discipline when it comes to costs and how they run their business.
And here's exactly how they pulled it off. They shut down 23 stores and 3 facilities that just weren't pulling their weight. Because of that, their operating income from the retail side actually went up. And maybe most impressive of all, they generated $13 million in adjusted free cash flow. Now, that might not sound like a huge number, but this is a quarter where they are supposed to be burning cash to stock up for back to school. It's a huge sign of strong management.
But look, this isn't just about cutting costs for one good quarter. This is all part of a much bigger, multi-year plan that management has. They call it Optimize for Growth, and it's all about fundamentally reshaping what this company is.
So the plan really breaks down into 3 key steps. First, you reduced your fixed costs. Streamline everything, close the underperforming spots, which is exactly what we just saw. Second, you sharpen your focus on the more profitable business-to-business side of things. And third, you take that B2B strength and you use it to push into totally new, higher growth areas, specifically hospitality and healthcare.
And you don't even have to take my word for it. The CEO laid it out perfectly. The key takeaway here is that ODP is starting to see its massive supply chain as more than just a way to sell paper and pens. They see it as a launchpad to get into completely new businesses.
Now, let's look ahead, because another huge reason the stock popped was management's confidence about the rest of the year. They basically signaled to the market that these improvements we're seeing, they're just getting started.
And this was the number that really sealed the deal for a lot of people. Management actually raised their full-year guidance for adjusted free cash flow. They're now expecting to generate more than $115 million. You got to understand, for investors, strong, predictable cash flow is king. This was a massive vote of confidence from the people running the show.
And this wasn't just some vague promise. They backed it up with real, specific reasons to be optimistic. They expect their B2B sales to start improving, they see their retail business staying strong, and crucially, that new hospitality business is really starting to get going. They've already brought over 1,000 new hotel properties on board.
So, let's put it all together. What's our final take here? For the next call, we're going to weigh the good against the bad, the bull and bear cases, and give ODP our official equity research style rating.
So, on the one hand, the bull case is pretty compelling. This company is a cash-generating machine, they're executing their turnaround plan flawlessly, and that new hospitality business is showing some really exciting early signs. But, on the other hand, the bear case is real. Revenue is still shrinking, a big restructuring like this is always risky, and demand from their main business customers is still pretty weak.
So after weighing both sides, our rating is market perform. Look, the company is doing an amazing job with everything it can actually control: costs, strategy, execution. But those headwinds on the sales front are still very real. So we're cautiously optimistic, but we're waiting to see if that revenue growth actually shows up like they're hoping.
Okay, now for our final segment, let's have a little fun. Let's put on our hedge fund analyst hat and cook up a more speculative trade idea based on everything we've talked about.
So get this. During the earnings call,
The CEO straight up said he believes the stock is tremendously undervalued. So, if you believe him, if you see the potential in this big transformation they're pulling off, how would you actually play it?
Well, here's the pitch. You go long ODP stock. The bet you're making is pretty simple. You're betting that as the company keeps beating expectations on cash flow and proving that this hospitality business is for real, the market is going to be forced to look at this company in a whole new light. And that could lead to a serious re-rating of its valuation, closing the gap between where it trades now and where its competitors trade.
At the end of the day, the trade is a bet that a company can successfully shrink its way into a new era of growth. Whether that bet pays off, well, that's all going to come down to execution. And of course, the obligatory reminder, this is all just for informational purposes and is definitely not financial advice.